Hello, Dan Passarelli here. How are you feeling today? Today we're going to talk about selling cash cured puts to generate income. And before we get started, first of all, I'd like to know that you can hear me. If you can hear me, please hit that Q&A box and let me know. Inquiring minds want to know. Thank you, David. Much appreciated. Now, before we get started, I need to point out options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. I see some old friends here like Tomas and oh gosh, David and a whole bunch of other people here. But I see some new friendly faces too. So allow me to introduce myself to you new folks. My name is Dan Passarelli, and I am an author of 3 best-selling option trading books. My most recent one is actually about cash secured puts. Go figure. It is called Build Consistent Wealth with Options. You can probably see it behind me right there on my bookshelf. And that is my most recent one. Just came out about 2-3 months ago. Spent some quality time on the Amazon bestseller list. And I also write for my Substack and many other things. Let's see here. I do my podcast. I am a trader. That's why I am here and why I think, and Firstrade thinks, you should listen to me because I've been doing this a long time and I learned some things through my experiences. Also, I am the founder of Market Taker Mentoring, which is the global leader in option trader education. We've trained thousands and thousands of traders in over 50 countries how to be better traders and investors using options. I am also a trading industry collaborator. I work with all the best firms out there, just about all the exchanges globally, just about all the options friendly brokerage firms, I guess again, globally. And, especially the good ones like Firstrade here. And I'm a family man. Those of you who are Market Taker students know my wife, Kathleen. She runs operations here with Market Taker Mentoring. Got my 2 adult children, and we've got my little dog who's a 6-pound Morkie, and we just sent her off today to military school. When you were young, did your parents threaten to send you to military school? Oh boy, yeah. If you grew up in the 80s and you were male, there's probably about a good 50-50 chance your parents threatened to send you to military school when you're bad. I know mine did. They never followed through with that. For dramatic effect, there was a time or two when they, said they talked to the corporal or whatever, but that's what happens when you're a troublemaker when you're a kid. It just happens. So yeah, speaking of troublemakers, my dog just started military school today. It's not really military school. It's, what do they call it? Obedience school, dog school, training. So, yeah, she has a little bit of what they call a Napoleon complex. When she sees a big dog, she goes crazy and starts barking at it. I think it's, fear. But, and by the way, did you know that Napoleon was not actually short? He was like 5'7", which was pretty typical for Frenchmen around that era, late 1700s. All right. Anyway, enough with the history trivia. I do other things for fun. I like to exercise. I love running. I'm a foodie and a traveler, been all over the world with either market taker mentoring or just for fun, and a musician. I like music as well. All right. What is cash secured puts? It's selling puts with a plan. Yeah. Isn't that the best way to put it? Selling puts with a plan. I nicked that from my old boss, Jim Bittman from the Chicago Board Options Exchange. Selling puts, but with a plan. Because when you sell a put, you might get assigned. And so we're going to plan for that potential eventuality. What I do is within my brokerage account, my broker sets cash aside, my cash aside, to potentially finance the purchase of the shares of stock if I get assigned. And they just sort of set that aside. This is an investor-oriented strategy, and there have been several studies done that show that it improves returns while lowering risk, which, geez, that's about the best of both worlds. So my motivations are to generate income on low volatility stocks or ETFs that I don't own yet, but maybe potentially I do. I want to potentially maybe buy a stock at a lower price than the current market price of that stock. And again, capitalize to do so because I've got the shares set aside. So I want to I want to expound upon this just a little bit. Excuse my voice today. I don't know what's going on. Maybe it's that smoke from Canada that's been permeating the air around these northern parts here. So, excuse me. Geez Louise. So, yeah, yeah. When I sell a cash secured put, I can want to do either or both of these things. And here's the mistake that a lot of people make when they start trading cash secured puts. And I've even talked to people who've traded them for a long time who still make this mistake. They'll say, yeah, I'm going to sell these puts because I want to get that premium. And I'm okay if I get assigned on it. It's fine. But the reality is, a lot of times, a lot of people, it's not fine. That's not really what their objective is. And then once they do get assigned, they say, oh crap, this is terrible. This is the end of the world. I didn't want to buy this stock. Crap. The strike is here and the stock is here. I'm way overpaying for the stock. Oh, woe is me. This is terrible. What am I going to do? Well, if you say, I'm okay buying the stock, you should only say that if it's true. In fact, I'll tell you what, I'm the kind of guy who believes you should only say anything if it's true. Really, especially if you're talking to yourself, for goodness sakes, right? So here's sort of the sanity check that I put on this. I say, okay, before you even make a cash secured put trade, let's set an objective. What do I actually want to have happen? Not what am I okay with happening, because that's just silly. With trading, like, we shouldn't be thinking about what we're okay with. We should be thinking about what we want to have happen, and then a backup plan for in case it doesn't happen. Now, sometimes I will sell cash secured puts because I don't think the stock's getting that low, and I just want to get that premium and skate on the put. Let it expire, not get assigned, or maybe buy it back for a nickel. keep the premium. Sometimes that is my objective, and I don't want to get assigned. Sometimes my objective is to get assigned. I use it as a quasi limit order. And when I do get assigned, sometimes it works out just swell where gosh, I bought the stock at a lower price than where the market is and everything's great. And sometimes, I buy it at the strike and the stock is lower and it shows a loss in the account. But I'm actually okay with that too. Because look, if you're using this cash secured put to buy the stock, how many of you have ever bought a stock as an investment in your IRA or whatever, and at some point the stock is underwater? The stock price is lower than it was where you bought it. You know how many of you that's happened to? Every single one of you, because that's just how it works. No one in the history of investing has ever bought stocks and never had it had them be a small loser at some point. At least a small loser at some point. Almost all stocks are at some point. So, when you start thinking about it that way, from an investor type standpoint, knowing that I could be underwater on this at some point, it becomes liberating. It becomes refreshing, because then I don't worry about, oh, goodness gracious, I'm down 50 cents on these or $2 on these. Oh, woe is me. I'm like, okay, yeah, that's fine. This is a long-term trade and I'll probably sell some covered calls on it. Fine. So my two objectives are, I want to skate, meaning not get assigned, or I want to trade into the stock. I want to get assigned and buy the stock. When you declare your objective first in your brain and in your heart, and maybe on a spreadsheet, or maybe on a platform that tracks this, everything suddenly becomes much, much better. Okay, so the risk reward situation with cash geared puts is, I have limited profit potential, but my risk is the same risk as owning shares of stock. And so, you look at this and you say, oh, well, so I can make a little bit, but I can lose a lot. This strategy kind of stinks. But there are some sweet spots. And the most common scenario is that you, Jesus Christ, I can't even talk. Huh. Hmm. Yeah, I don't know. I guess it's that smoke that's been going around lately. Jeez. I'm not a smoker. There's these, if you're not from the area, there's these wildfires in Canada and all smoke is coming down this way. It doesn't seem smoky today, but I haven't even been outside. I've been working all morning. Okay, so anyway, let's take a look at how these work. So let's say I sell one August 60 put at $2.75. Oh, it affected you the same way, David? Yeah. Geez Louise, it's terrible, right? Okay, so sell one August 60 put at $2.75. So the operative thing is this. If you probably do this when the 60 puts are out of the money. So meaning the stock is above $60 a share when you make this trade. If that strike stock relationship doesn't change, the moneyness doesn't change, then, and so therefore at expiration, the 60 puts are still out of the money, If you hold this all the way until expiration and the 60 puts are still out of the money, then they will expire worthless and you will get to keep that $2.75. And the 60 puts are gone and you've reached your maximum profit potential. Now, what if the stock is below $60 a share at expiration? Then what happens? Well, then you would get assigned on your 60 strike puts. What does that mean? That means you buy the stock at $60 a share. But guess what? You also still have that $2.75. So for all intents and purposes, you basically own the stock at $57.25 now. You get this sort of extra cushion. That is what we call the break even. The break even for cash cured puts is the put strike minus the premium we collected when we sold the put. So 60 minus $2.75 is $57.25. So there is kind of this sweet spot. And it's kind of important. Well, no, it's extremely important to understand that. Let's say at expiration. Oh, wait, hold on a second. I clicked the wrong button. Now I'm saying at expiration, but realistically, I don't always hold my cash cured puts until expiration. I often get out of them before expiration, but it's much easier to understand them when we talk about what happens if we hold them till expiration. So if I hold it till expiration, let's say the stock is in the range of, let's say it's below $60 a share. Let's say it's $59 a share. Now, what was my decision at the time of selling these puts? Let's say the stock was at like 61 when I sold these puts. Well, I could have bought the stock at 61, or I could have sold the 60 strike puts. So now that I sold the 60 strike puts, if the stock is at 60, great. I bought the stock at 60, but also have the 275. My effective purchase price of the stock is $57.25. So I bought the stock at $50.25 basically. In fact, even if the stock is at 60 or at 59, I still bought it effectively at $57.25. So basically, if the stock is anywhere above $57.25, I'm in a great situation. I will have bought the stock at a lower price than where it's trading, right? If it's trading above there. So it's between 60 and 50 and 57.25. I totally outperform, and I'm breaking my elbow, patting myself on the back. If it's below 57.25, well, then it's still better than having bought it at 61, where it was when we first put on the trade. It's like working a limit order. And I'm like, phew, I'm glad I didn't buy it at 61. I'm glad I was patient and strategic and bought it at this lower price. Sure, it's underwater now, but I'm looking at this as a long-term investment. Now, what if it's above 60? Well, that can be good too. I make $2.75. But what if the stock zipped up to 80? Well, then my elbow's going to be fine because I ain't patting myself on the back. I'm saying, gosh darn it, I should have bought that stock at 61. Too bad my crystal ball is broken. But I mean, if it's like, let's say it's at 62, I might hurt my elbow. I'm still patting myself on the back. Why? Because if it goes from 61 to 62, well, if I bought the stock at 61, I would have made $1, but I actually make $2.75. So we've got like what I would call an indifference point up at wherever the stock was when I made the trade, plus the $2.75. So if it's below $63.75, yeah, look out, elbow. I'm going to be wearing a brace for the next 6 weeks. I'm in good shape. So anywhere between 57.25 and what did I say, 63.75, this mid range, in hindsight, I did something smart. Now I'm going to kind of backpedal on that statement because just because you made money does not mean you did something smart. So we're going to talk about ways to actually know how smart it is before the trade even plays out. But if you think about stock prices, professors will tell you that they're log normally distributed, which basically means that smaller moves are more common than bigger moves. And so usually the stock ends up within some sort of range from where it is as time plays out. Could go up, could go down, but more often than not, the most likely place for it to be is within a range, and that's what this is. We just want it to be within a range. So it doesn't mean all trades will work out because they will not, but the vast majority of them should. And that's what studies show, that this does outperform the market and does so with lower risk. So let's look at a pretty realistic and recent example. In Intel Corporation, let's say I'm looking at a chart of Intel. This screenshot was just taken a couple of days ago, if you're watching this live on July 21st, 2026. And geez Louise, John, who helped me put this together, he was totally right on this. John's a good trader because it's up since then. So let's say I identify support at $100 a share, which there is support at $100 a share. And so I say to myself, let's make some money on this. I think that it's going to hold. And I see a lot of positives going on with Intel stock. And so I'm going to sell the 100 strike puts that expire in 4 days, which I can sell at $2.54, maybe even a little higher, maybe middle of the market. And that's with the stock at about $103 a share. So if I sell the Intel July 17th 100 strike puts at $2.54, what does that mean? Well, same situation here, right? If Intel is above 100 at expiration, then I get to keep that $2.54. Now, if it was at 103 when I made the trade, so right around here, if it would have gone up by anything less than $2.54, I actually did better than if I just bought the stock. If it goes down even to $100 a share, gosh, I'm glad I didn't buy the stock at 103. If it's below $100 a share, then I buy the stock at 100 when I get assigned at expiration, but I still get to keep that $2.54. And so my break even again is the put strike minus the put premium. So my effective purchase price, or my break even, you can call it either, is $97.46. So yeah, if I've got support at 100 and I actually like the stock as a long-term investment, I'd love it if the stock settled at expiration between 97.46 and 100, because my assignment effective price is $97.46. So I outperformed the market. And hey, if I like it as a long-term investment, even if it's at 96 or 95 or 90, I still did way better off than pulling the trigger and buying it at 103 when I was making this decision. And these are some things that people don't really think about, or at least they don't really think enough about when I talk to them. We really have to think about cash cured puts the right way. Most of the time, I'm thinking about them as a long-term investor. And when I think about it that way, it becomes a pretty powerful strategy. Because really, I mean, if you want to really look at the risk isn't to the downside. I mean, sure, mathematically, it kind of technically is. But if you look at yourself as a long-term buy and hold investor and recognize that every single stock you buy at some point is going to be down some money on you, at least a penny, probably at least more than that at some point in the history of owning the stock over a 10-year period, then you can make a case for saying the risk isn't to the downside. If I get assigned, even if I'm losing money, it's a way better trade than just buying the stock. Way better trade. You always do better if you sell a put to get into a stock than just buy the stock. Always. If you buy the stock. The real risk is to the upside. When these stocks go from 103 to 150, then you leave money on the table. So that's the only thing that you have to be okay with. But that's not really about being okay with something either. That's just understanding the mathematics of the game. Stocks, there are some stocks that really take off to the upside. And when they do, you can make a lot of money if you own the shares of stock. But when you sell the puts, you don't. But all the other times, you're always better off than the buy and hold strategy. So on this investment, I do better. I make a little extra cash. On this one, I do better. I make a little extra cash. On this one, I do better and I make a little extra cash. On this one, even though I'm down money, I still did better by dollars and did dollars better. Everything's looking better. But then you have that one that really takes off and you say, oh, crap. There's some money that I left on the table, but I've actually got other money on the table to balance that out. So this whole thing just becomes a different game, is all it is. It's just a different game. It's not better or worse. It's not about leaving money on the table or the stock going down too much. It's just a different mindset and way of looking at it. You get, it's kind of like that baseball player who gets on base all the time, but always gets on first base all the time, has a very high batting average of getting on first base. It's a valuable strategic player. But then you've got this other player who's like Babe Ruth, who hits more home runs than anybody else, but also strikes out more than anybody else. Which of those players are better? Well, I mean, they're both good, right? And they're both strategic, but they're just different. And there's some situations when you want to put Babe Ruth in, There's some situations where you want to get that guy who just, has a great chance of getting on first base and, doing that. So this is not necessarily, well, actually, studies show that this is better than the buy and hold strategy. But, it's just different. Okay. So let's go through a couple of thoughts on this trade that we're just looking at. What was my motivation for this Intel cash secured put trade in the previous example? Well, the motivation needs to be more than just, oh, I can collect $2.54 for this. Great. Because that limited profit potential is small. We need to really look at the bigger picture. We need to hope one of two things happens. We skate and keep the premium, or we get assigned and buy the stock at an effectively lower price. We need to have the objective of one of those two things. Can the objective be both? And that answer is yes. The cash to buy the stock is secured in the account. And so, like a lot of people say, oh, but with the cash secured put, you have very leveraged losses. I stand to make $2.54, but I can lose $10. You're thinking about it wrong. You have to think about, what is my investment on this trade? And that's a weird question for a lot of people to wrap their heads around. What do you mean investment? I'm collecting $2.54. There is no investment, but in reality, there is. Because if I sell this put cash secured, so I mark it as a cash secured put, your broker is going to say, okay, well, you might get assigned. So you're going to sell these at $2.54. You're going to get $2.54 a share, so $254 per one contract, put into your account. But because you might have to buy the stock at $100, 100 shares of it, we're going to take $10,000. So $100 a share times 100 shares is $10,000. We're going to take $10,000 of your money, and we're going to put it in a different part of your account. And when we do, you can't touch it. You can't touch it as long as you have that put on, because that cash is securing the potential purchase of the stock that would happen as a result of assignment. So isn't that kind of like you're buying the stock? Isn't it kind of like that? If you think about it that way, your investment here is $10,000, because sure, you're not technically paying for the stock now, but that money's tied up. It's kind of like buying a certificate of deposit at the bank, right? It's your bank account. It's your money. You put it in there, but you just can't touch it. And you do think of a certificate of deposit as an investment. Not that those are very popular to buy these days anyway, but some people do, and sometimes it makes sense. That is an investment, but it's just your money. It never leaves your hands, but it's just you can't touch it. You slap your hand if you try to touch it. That's exactly what's going on here. So you need to think of the cash secured put as an investment in and of itself. Now, just like with a certificate of deposit, a CD at the bank, there's an interest rate associated with that. And what's the interest rate here? Well, I mean, if I don't get assigned, which is the most likely outcome, it could happen that I do get assigned for sure, but the most likely outcome is I don't get assigned because it's out of the money. So how much do I make on that $100 a share or $10,000 of money investment? Well, I make $2.54 a share. So I take 2.54, right? Divided by my investment of 100 is over this 4-day period, I make 2.54%. Now that's not an annualized figure like you would be if it was a CD. That's literally 2.54% in 4 days. I mean, if I were to annualize that times 365 equals divided by 4, it's like a 232% annualized return. That's pretty darn good. Now, yes, on the one hand, you have to repeat that annualized return every 4 days, but do you really? No. What if you just made, when that expires, you just make a different trade that maybe has 4 days till expiration, but maybe has 5 or 6 or 10 or 20, but it's still a good annualized return. Well, it's just like selling a CD, cashing out a CD at expiration of it to take that good annualized return, whatever that good annualized return was, and doing a different CD that has a different interest rate that has a different good annualized return. You're still making good annualized returns. So for the skate objective, that is exactly how you think about it. If you're thinking about it any other way, you're just thinking about it wrong. You got to think about it this way. It's the only logical way to think about it. And then if you get assigned, okay, great. I'm buying the stock at a lower price. And if my objective was to get assigned, it's a win-win. If I don't get assigned, I'm earning money at like a 200 something percent, a 232% return a year. So, I didn't meet my objective of getting assigned, but I still made a great trade. And if I do get assigned, oh, good, I met my objective because I thought that the stock was undervalued. And I think that 100 strike will ultimately hold, even though we went through it a little bit. Nathan says the biggest challenge I find is screening for high ROI opportunities. Do you have a screener you recommend or a good way of combining the entirety of option chains for opportunities? Obviously have to comb through a screener to weed out the junk. High volatility, low quality companies. Yes, Nathan, I do have one. And it's a platform that I am working on that is just about ready. So now I forget if you attend these webinars every week. If you do, show up over the next couple of weeks, or actually, I'll tell you what. If you just go to markettaker.com/reg, I'm going to be talking about this platform and giving you an opportunity to try it out. So I'm going to type that answer here, markettaker.com/reg. And you can register for the webinar that is coming up the beginning of next week. And then I'm going to talk about the platform, and you are going to have the opportunity to use all these pretty wonderful tools that I've been working on. You're going to love them. Okay. Does that all make sense to everyone? So here's another thing. The situation here is I have basically all the risk of owning the stock, which I would only make this trade if I want that risk, or I think that that risk is not a big risk because I'm confident that the stock will stay higher. But I have limited profit potential. Does that sound, I mean, does this strategy sound like any other type of option strategy that you know? Can anyone tell me an option strategy that sounds similar? You basically have all the risk of owning the stock, but you have limited profit potential, but you're collecting an option premium. Do I got to hit you over the head with this? Oh, well, Nathan says covered call, same exposure. Wait a minute. That can't be right, could it? I mean, this is a put. That's a call. Could they possibly be the same at all? Well, let's take a look. Nathan is 100% exactly correct. Cash secured puts and covered calls are related. They're kind of, when I say related, I'm not talking about like second cousins twice removed, which I forget about how all that stuff works. We were just talking about this last night. We were out to dinner with some friends, and I was talking about my cousin that I hadn't seen for a while, and they're like, "Oh, well, how is she related to you?" I was like, "Well, my grandmother's brother is her grandfather." And so my friend's like, "Oh, well, that's like what? First cousins twice removed?" I'm like, "I don't know, man." There was one day when I sat down and figured it all out, and I remembered it for like probably a month, and now I forget it. But these aren't like second cousins twice removed. These are like identical twins. They're synthetically related. What does that mean? Well, what it means is they have identical P and L diagrams. Those little hockey sticks that we were just looking at, they both look exactly the same if we're talking about the cash secured put versus the covered call, which is short a call and long stock. As long as we're talking about the same stock, same expiration, and the same strike price. And there's kind of the rub. There's why people look at them a little bit differently, because more often than not, with a covered call, you own the stock and you're short a call that has a higher strike. More often than not, when you're short a cash secured put, you're short a strike that's below where the stock is. So covered call is typically below, cash secured put is typically, or no, covered call is typically above where the stock's trading. Cash secured put is typically below where the stock is trading by strike. But if you were to use the same strike prices, so if it's an out of the money covered call, it would be an in the money cash secured put. They actually profit or lose the exact same as each other. It's true. And that's kind of weird, right? Sometimes when I explain this to people who have just learned enough about options to be dangerous, as they say, they call me a liar, call me all kinds of names. That can't be true. Passarelli, you're crazy. You don't know what you're talking about. But the reality is they are. And the options textbooks will show you the math behind this. In my newest book, Build Consistent Wealth with Options, I talk a great deal about it. Okay. So what does that exactly mean? Well, if you basically what it means is if you think covered calls are good, then you must think cash cured puts are good. And if you don't, if you think one's good and one's bad, you got to dig into synthetics. You got to understand this because it's very, very important. It will make you a massively better trader once you come around and understand this. All right. Next, what kind of analysis do we have to do? Well, we always have to do 3 analyses, whether it's skate or trade. From a technical standpoint, we need to see support, and we prefer low stock volatility. A stock that's going crazy, there are some situations when they do make good cash cured puts, but more often than not, the most common used case is you want low volatility. Now, as far as volatility goes, the implied volatility, which is different than the stock volatility. The stock volatility is called realized or historical volatility, and that's just how much the stock moves around. The implied volatility is a measurement of how cheap or expensive the option is. And it's assumed to be based on it's assumed to be based on traders' assumptions about future volatility. And there is some truth in that. There's a lot of truth in that, but that's not just 100% tight and universally true. So the implied volatility, which when you see those words together, implied volatility, your brain should say, oh, that's the relative price of the option. That's a normalized price of the option. When I take out the influence of direction and time and interest and gamma, the higher the implied volatility, the more expensive. The lower the implied volatility, the less expensive. So I want the implied volatility to be in the top half of the recent range of the implied volatility. And I also want it to be above historical volatility. Those are 2 indications that the implied volatility is too high, which means the options are overpriced. When I sell something, I want to sell something overpriced. This is a bargain hunting scenario. Right now, my son is trying to buy a used car. Anybody have a decent decent cheap junker used car that's going to last a while? Email me, please. What he's looking for is a car that, yeah, 1 second, Nathan. What my son is looking for is a car that, probably has a lot of miles because, he's not going to pay a lot for it. But is going to last. And there's lots of different cars out there. Cars are different than options because options are fungible. The May 30 puts that I buy in the SIBO are the same as the May 30 puts I buy in the Philly. All the contract specs are the same. When it comes to cars, each one is unique and individual, right? But my son is looking for a car that, is decent, but he wants to pay lower than what he thinks it's worth. Now, the people selling the cars, they want to unload it and get paid somewhat more than they think it's worth. What was that? Yogi Berra said, a tie is like kissing your sister. This is what we do when we're making any sort of trade or transaction. The buyer wants to buy it for less than value. The seller wants to sell it for more than value. So that's what we always want to do with cash secured puts. We always want to sell it when it's trading at a price that's higher than what it should be worth. And that's why we do the volatility analysis. Fundamentally, we want to avoid earnings or other expected volatility events. And we might do a fundamental analysis, like maybe discount cash flow or something like that, where we see what the stock arguably should be worth and set the strike price below there. So we want to do all three of these analyses always, but if we want to skate, the technical analysis is a little bit more important. If we want to actually buy the stock, the fundamental analysis is a little bit more important. So the volatility comment, yeah. So, oh gosh, I don't know. I talked for like 4 minutes about volatility. Implied volatility is how cheap or expensive the option is. That's your takeaway. If you're taking notes, write that stuff down. Implied volatility is how cheap or expensive the option is. We want to see it in the top half of the recent range and above historical volatility, because those are two indications that it's likely overpriced. You know, there's a science, but also an art to analyzing volatility. But you start with what I've got here on the screen, and I'm going to tell you what, you're going to be literally ahead of 90% of option traders. That's the thing, man. I have Market Taker Mentoring, my options education company. But the thing is here in Firstrade webinars that I do each week, which are free to you, I give you some really good information. I believe that the stuff that I covered here today is going to put you ahead. It's literally going to put you ahead of 90% of traders if you just do things I'm talking about. Nathan, thanks. Top end of recent range and IV higher than HV. That was what I was trying to capture. Yep. You stick with that, you're in good shape, my friend. Next, management, super important. If you put on the cash secured put and the stock is trending lower, is that good or bad? Depends on your objective, doesn't it? I might just let assignment occur, especially if that's my objective. Even if it's not my objective, I might still let assignment occur and go into the other half of the wheel and sell a covered call on it. I just did that on a stock. I got assigned on Friday and got assigned on a put on Friday and sold a call on it yesterday. If the stock moves violently lower, I might close the trade if I had the skate objective, didn't want to get assigned. And, because the put is already starting out of the money, I might be able to close it just for a small loss. I can even use a stop loss on it because it's a single leg trade. With two leg trades or multi-leg trades, I say never use a stop. You end up getting hosed. But with single leg trades, yeah, using a stop's very smart. If I get assigned, again, I can actually do two things. I mentioned one of them already. The second bullet point here, I can sell out. If I get assigned on the put, now I own the shares, so I can sell out of the money calls and establish a covered call. I love to do it at the same strike, or in a perfect world, if things work out great, sell the covered call at even a higher strike. So then if I get assigned on the covered call, not only did I collect two option premiums, the original cash secured put and the out of the money covered call, but I also bought the stock at the lower put strike and sold the stock at the higher call strike. So it's like triple dipping. It is the beauty of the wheel strategy. Or I can just hold the stock, and I've done that before too. Just sold puts so that I get assigned and just wait. Maybe I do that because it's got a good dividend yield. Maybe I do that because I think the stock can really take off to the upside. I might set target prices for a stop loss for the stock now, or I might set a profit-taking order if I don't want it to be a very long-term investing situation. Daniel says, can I set up an account on Firstrade to trade without cash? Maybe if the Firstrade people are still here. I'm not sure if they always stick around and, listen to my classes or not. But if they are and they're here, it would be great if they could answer that. I don't like to talk about the ins and outs of brokerage firms because I actually don't work for Firstrade as an employee. So all I care about is that you're getting the best information out there. So hopefully the Firstrade people can answer this for you. So cash secured puts, let's just kind of recap. Like all option strategies, they have a specific person. No, not a specific person. Short puts, like all option strategies, have a specific purpose. We use them to meet an objective, to skate on the put or to trade into the stock. And I do some math to determine if it's a good trade, and I do some other analysis to determine if it serves me. I see what the market, the first step is to look at the market and come up with a forecast and what I might want to do. And then I select the strategy that fits the market. And if a cash secured put helps me reach my objectives best, then I trade it. And if some other strategy does, then I trade that other strategy, the strategy that fits the market. And then once I decide that a cash secured put is indeed the type of trade that benefits me the most right now, then I do some other math to decide between which expirations and which strike prices. And in that webinar that I'm going to have next week, I will be talking about a lot of this stuff. Yeah, I'm going to be talking about a lot of this stuff. So again, that's markettaker.com/REG to register for the webinar. I think that's set up. Let's just double check. Markettaker.com/REG. Yep. Tuesday, July 28th. Be there and you're going to love it. I'm so excited about this platform. Okay. That being said, have a great rest of your day, friends. Trade smart, and I will see you next week when we are talking about short squeezes. That's going to be a great one. All right. Talk to you then. We'll see you next week. Bye.